You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode. Hey everyone, welcome back to another episode of QSBS Solved. My name is Brady, and I'm pleased to be joined today by Dr. Daniel Gilham, Managing Director of Advisor Strategy at Farther. Farther is one of the fastest growing financial firms in the country, and Daniel has a ton of experience in wealth management that I'm excited to be able to share with everyone today, and also talk about entrepreneurs and business owners and some of the opportunities that exist in financial planning, especially around tax and wealth management overall for them. So thanks a lot for joining, Daniel.
Yeah, thanks for having me. Pleasure to be here.
Yeah, I'm hoping maybe we can jump in just first, give us a little bit of background about yourself. I know you've been in wealth management for some time, and were in some time before you joined Farther. So give us the high-level overview.
Yeah. Well, I had a unique opportunity early on in my career to join another fast-growing company. You might remember it as America Online, or AOL.
Nice.
So right out of school, I was a systems engineer, turned into training, and then did some product management. Really interesting opportunity to be there through the late 90s, through the mid 2000s. So I got to live through the tech crunch, got to travel all over the world. Lived in India for 6 months, standing up our operations there. So that was a phenomenal experience, which really led me to financial services. I mean, if you think back, you're 22, 23 years old, you have all these stock options, you hear about everybody making all this money, becoming millionaires, and then all of a sudden, boom, they have nothing, or much less, right?
Yeah.
It was really interesting in my role as product manager, is traveling around the world, traveling around the country. We would travel with our consultant team, and I'll never forget being on a plane, and our consultants would say something like, "Hey, we know the AOL employee stock purchase plan is coming up. What are you doing? Are you going to keep your shares? Are you going to sell them?" So the joke became that I was the team's financial advisor. I was like, "Oh, this is interesting. If I never become the CEO of AOL one day, maybe that's something that I can go help
What's
people
Daniel
do."
doing with his money? That's what I want to do, kind of thing.
Yeah. So it was a ton of fun. I transitioned out. I was in Washington, D.C. at the time, transitioned from D.C. down to Florida in the mid 2007, and joined Merrill Lynch in 2008, went through their training program, and then moved over to Wells Fargo. And that's, it's interesting because I feel like that's what brings us together today. That's where we started realizing the need for business owners and planning. So we spent a lot of time working with business owners, pre-liquidity, how do we plan for that liquidity event? And then what does it look like on the back end? And then I had this weird idea to go back to school. So went and did some research, and in my research around how do we create efficiencies for advisors, I found some ideas, took them back to Wells Fargo. And they didn't care to hear about my suggestions or ideas. So through some frustration, I met and a mentor of mine. I met the co-founder and CTO of Farther, and our visions just aligned on what the future of financial services look like. So I made the move 4.5 years ago over to Farther.
Yeah, the landscape has changed a ton in terms of available, the software that's available, the automation that's available, the ability for advisors to give their clients a more comprehensive day-to-day, week-to-week view of their portfolio through technology. I mean, what's the maybe two things in terms of the largest leaps and bounds that you've seen in technology since you got into the space till today? I mean, Farther's completely online. It's, kind of online native, right, in terms of advisory. What are maybe one or two biggest changes that you've seen?
Yeah, I think there's been a big move to the comprehensive nature of the advice that's given, right? You think about in all industries, things become commoditized as they grow, and especially with the use of large language models, AI, et cetera. So we've seen a big move of the investment management piece really becoming commoditized. So then where is the value? Where's the true benefit of the engagement with an advisor? And I truly believe that that's been a big shift of how do we automate the investment management piece in a very curated manner. We have the ability to do that here at Farther. So we can automate much of the investment management, the rebalancing, the structuring, asset location, tax loss harvesting, all of that. So it takes a ton of time off of the plate of an advisor so they can focus on what's truly important for the clients that we serve, which is, am I able to achieve my goals? Am I able to sell my business? And if I do, what am I going to do with the tax bill? And how am I going to ensure that the next generation that's inheriting this money has the work ethic that I had to build the business and in the grit and grind that I went through? So that's been a huge shift. And I think we're seeing it at firm levels, but also at the client level, where clients are just expecting more. They're expecting more of a comprehensive solution around not just investments, but around taxes and estate planning and cash flow management and value acceleration methodology within the business.
Yeah, there's a lot of conversation about this today, and it's very, very clear that the wealth managers who think that their bread and butter business is still allocating to mutual funds, they're quickly, if not have already been left behind, are quickly being left behind. Because like you said, minimally savvy clients can do a lot of investment management on their own until they get to, maybe a greater amount of complexity. But it is the goal setting and how do we get to those goals, estate planning, business transactions, how to manage those, where a ton of new value is created. And the reality is that maybe the bottom part of the wealth management industry is being kind of just eliminated and cut off. Bottom part, I mean, where it's a family with $200,000, managing some core investments. I think that wealth management is going to become much more knowledge focused and advice focused over time. It feels like it has to now.
Yeah, I don't disagree with the latter part of that. Maybe on the first part, it is truly dependent, and this ties directly into business owners, right? I'll never forget at Wells when we first started getting into the business owner segment. A lot of these firms have pretty high minimums, right?
Yeah.
It started out at $250,000 minimum, or you don't get paid to service that family, and then it goes to $500,000, it goes to $1 million or $2.5 million. The reality of it is those families that have 200,000 of liquid assets have other assets that they need to understand how to incorporate them into the cash flow plan, into the risk management plan that they have. So even if it's only 200,000, I would say that it is beneficial to at least have conversations around how to structure the asset. What does the balance sheet look like? And it's not just about how you're allocated in your investments, but it's where your investments are located. So we talk a lot about asset location, and that helps with tax efficiency. It also helps with risk management.
Yeah. So 401ks, Roth IRAs, trusts, the vehicle, how you're holding your investments. If you have $1 million in a fully taxable brokerage, that's a very different portfolio than, having some advantaged accounts and qualified funds.
Yeah, absolutely. We've seen families come in and their asset allocation is okay, but the asset location is in complete disarray.
Yeah.
You analyze the taxes, you reposition the location of those assets within their portfolio, and you see a substantial reduction in the amount of taxes that they're having.
Yeah, of course. Okay. Let's hone in a little bit on business owners, entrepreneurs, startup founders, the kinds of folks who very often maybe have a lot of wealth on paper. Maybe they have equity in their company, but they haven't quite gotten liquid, or they're taking a good salary, and now they're starting to think about the long-term plan. Maybe they even know, quote unquote, know with whatever degree they can that there's going to be a liquidity event of some kind in the future. Yeah, tell us a little bit about that demographic of clients at Farther, what the core needs are, and maybe what are the first three things that you would hope your advisors start considering when a client like that is sitting, on the other side.
Yeah, it's interesting. What I found in research is that 82% of business owners say that their business is their largest asset.
Mm-hmm.
And I don't believe that the financial services industry has been focused enough on that large balance sheet item. And we could take a step back and make some assumptions. Why? Well, because our industry, the financial services industry, is typically charging a fee for the assets under management. Well, if 82% of your assets are tied up in an illiquid, concentrated position, do we want to take the time to dig deep into planning and estate analysis, tax analysis, et cetera? So I think that's the big opportunity for the financial services space, is to level up cognition around business owners, help them understand what the value of the business is today, where it could be. So that's that value acceleration methodology that we talk about. Here's where we are today. We can foresee, as you said, I'm going to have a liquidity event in 18 months. Well, it's never 18 months.
Yeah.
It's either 6 or 36.
Right.
But the idea that you can engage in an exercise to start identifying what those key drivers to value within the business are and start working on it so that you can see the accretive value within that business over time. That helps the planner, right? It helps the advisor understand that, hey, I know you think your business is worth $20 million, but it's actually only worth 7. But if you want it to be 20, these are the things that we need to do over the next 18 months, 24 months to get it to that value. And if it is 20, these are some things that we should consider. So we engage in a lot of modeling around, okay, your valuation is X today. We expect it to grow to be Y. If that is the case and your goal is to remove assets from your estate, we might want to look at a grant to retain annuity trust, right? Let's move some of the shares out of the estate so all of that growth is outside of your taxable estate. Key man insurance, buy-sell agreements. These are all the types of conversations that we should be having with these business owners and founders before they get to that liquidity event.
Something I'm interested in is how founders and business owners get paid, and in terms of like month to month, year to year. What are some interesting strategies or things that folks should consider when they're able to start paying themselves, say, hundreds of thousands of dollars out of their business each year? And, maybe they only, quote unquote, need the first 150 of that. What are some other ways outside of maybe like a 401k and boosting that program within your company to, help advantage you? What are some other things that business owners can do to pay themselves well before a liquidity event in an advantaged way?
Yeah, one of our most highly utilized strategies around that is it's incorporated with the 401k, but it's plan design, right? So you have your 401k. Does it make sense now to start incorporating profit sharing within your business,
Mm-hmm.
and then layer on top of that a cash balance plan, which is kind of, now you're looking, instead of just a defined contribution, you're looking at defined benefit type of strategies for the business owner. And I feel like this is such a unique opportunity to solve multiple problems, or opportunities, maybe is the better word there, where the business owner can not only defer several $100,000 into the cash balance type of strategy, but it also allows you to really focus on retention of talent. When we talk to business owners, there's a few things that come up. Taxes is always one of them. The other is, hey, I know that the job market is fairly competitive. Look at the AI world right now, where these engineers and are being extracted from these larger companies in absurd amounts of money, right? It's how do you attract and retain talent? So there's some unique opportunities within a well-designed plan to attract great talent, retain that talent. And what that does in the meantime is also increase the value of the business. Because if I'm a buyer and I'm coming in and QSBS rollover looks really appealing to me, but if I buy it, Brady's gone, I don't think that the business is worth as much as it is with you in the business. So if we can construct plans to retain those key people within the business, it not only helps defer taxes for the business owner, but it also helps accelerate the value of the business.
I'm sure of your career, you've had the client who just had a 10, 20, 30, $40 million plus windfall and needs to figure out, hey, how much is my life going to change? How much does it need to change? How much can it change? Those types of questions, but also that moment of anxiety of like, now I have a new full-time job functionally, which is, preserving this wealth for the things that I want to accomplish in life and what I want my family to be able to achieve when I'm gone. Much thinking around trust and estate and setting up structures for folks as far they're able to do in-house, and are there other partners that you work with to be fully comprehensive, that type of planning?
Yeah, you bring up a great point, and you would think that there would be a pretty well-defined process to help business owners through, but it is so unique to each and every family that we work with,
Mm-hmm.
right? Some business owners just feel like it's a windfall and they're so blessed and they're never going to spend the money and they start giving it away.
Sure. Yeah.
Others are, they've had control of their business and been running their business for X amount of years. And once it's gone, there's this fear that sets in. It's like, oh, my source of wealth, my source of income is now gone. And you kind of go to this hermit mentality. And then there's others who are like, oh my gosh, I got my windfall, I'm going. And there's private jets and homes in various cities. And 3 years later, they're like, oh, we probably need to revisit this plan, right? So across that spectrum, that's why it's so important early on to truly understand the psychology of money and wealth and what it means and what the goals and objectives are of the family. Because once you have it on paper and you can visualize what it's going to look like over time, I think it brings some tangibility to what the future looks like. And that leads to trust and estates planning, the tax analysis, et cetera. Internally here at Farther, we do have a trust and estates team. We do not provide legal advice. We do not draft documents. But it gives us the ability to model out these different scenarios, right? So I had mentioned grant or retained annuity trust earlier as a way to get some assets outside of the estate. Charitable trust, we do a lot of that planning in the year of liquidity, right? How do we reduce the amount of taxes? How do we front load some of those future charitable contributions, whether it's a charitable trust or donor advised fund? If large enough, maybe it's a family foundation. We incorporate qualified small business conversations quite a bit. So these are all things that we think about while we're not drafting the documents. We're able to model out the different scenarios for the family and help them see how this new liquidity is going to provide that income and help them achieve their goals. One story I like to tell that's frequent and just happened. We've got an advisor out west who is working with a family. We ran an analysis on their existing estate plan, and we were showing that they were going to have an estimated $14 million estate tax liability. So you put that on paper, or you put that in front of the family, and hey, this is what it is. Do you have a checkbook? Go ahead and pull your checkbook out, or write a check for $14 million to the Internal Revenue Service. See how that feels, right? And then you walk them through kind of modeling different strategies, whether it's a spousal limited access trust or the charitable trust, et cetera. And we were able to reduce that projected tax liability down into the hundreds of thousands. And that's tangible. That goes back to our previous points, right? That is where the future of advice is. And that's where the true value. Is that worth paying an investment advisor fee? I think so.
I would think so, yeah. Yeah. Yeah, you could probably pay that advisor $1 million because they just saved you 13. So, and it'd still be your best investment.
Good idea, Brady. Maybe we should increase fees across the firm.
Yeah, you're not thinking big enough. Not thinking big enough. I know you've done a lot of work in your PhD time working on your PhD to think about the way that advisors broach these conversations and have more productive planning conversations around some of the things that we've already talked about here, trust and estate, long-term planning, whatever it might be. Share with us a little bit about that work that you did, and how it applies to what you're building at Farther and how you try and coach up your team of advisors.
Yeah. Well, the whole idea of going back and doing the research really came out of frustration, right? Of working with business owners, understanding what they want, what they need, and then the available services that we had available. It's like, there's got to be a better way. So initially set out to uncover how we could create efficiencies for financial advisors. And if we look at it macroeconomic perspective, we have this huge generational transition of wealth, right? When I was doing my research, the number was 68 trillion. I think it's up to like 84 now. Anyways, there's a lot of money that's transitioning from one generation to the next over the next decade. In that same decade, 9 million baby boomers are selling their business. In the same 10-year period, 38% of financial advisors are retiring because the average age is near 60, right? So it's a supply-demand imbalance. So there was this idea that how can we use technology to create efficiencies to allow advisors to serve more people in a more customized way? So I start digging in, finding some interesting ideas, taking them back. I had mentioned this earlier, but taking them back to the previous firm and not getting a lot of traction. So through this process, my dissertation committee is like, Daniel, this is great. You're finding some really interesting opportunities here, but you got to dig deeper. You got to get more narrow. And that led me to this concept of, okay, we have this large generational transition of wealth. We can use technology to help advisors be more effective and efficient with their time. But how do we increase the adoption of comprehensive planning for business owners? So that led me to the numbers of 19% of clients and business owners that are engaged in comprehensive planning, and only 11% of financial advisors that are executing on comprehensive plans for these clients. So how do we elevate that, right? How do we take it from 11% of the industry to 25% to 40%, right? Sounds altruistic, but at the end of the day, that's what we need to be doing as an industry. So went out, I did one-on-one interviews with financial advisors, with business owners. I did focus groups with business owners and financial advisors, took all of the transcripts from all of those interactions and codified them, really came up with 3 themes: time, cognition, and risk. So those are the 3 inhibitors to adoption of comprehensive planning for business owners. So if we think about this, business owners, right, they're busy, they're focused on growing their business. That's their primary focus. 82% of their net worth is in the business. Let's focus on that wealth. And then from a financial advisor's perspective, they're managing portfolios, they're rebalancing, they're trying to find new clients, et cetera. So they don't have the time to really dig into deep, comprehensive planning. And then cognition. There's so many intricate details and so many opportunities for planning with business owners that it would be really tough for one single individual to know all the things to think about. I mean, Brady, we've talked about this in the past. It amazes me how many people don't know about qualified small business stock, right? So that's the cognition piece. And that's why I love what you guys are doing. It's really about raising the bar around education and awareness so that advisors and business owners alike can ensure that they're taking advantage of all the opportunities that are available for them with their business and with their liquidity event.
When you guys bring new advisors into Farther, is it a shift, previous culture and experience of dealing with clients, or even just like at the firm level, with the vision that Farther is trying to instill in their advisor base. Can you talk about the culture of that, and if Farther to you feels like a shift just culturally in the way that advisors think and work, or is it process? Are the main changes process?
Well, this is going to sound maybe a little self-serving, but it's definitely culture, number one. But the reason why there's such a lift in culture is because of the technology, productivity, and efficiencies that have been created. So I'm sitting in Dallas right now. This is where we have a big presence for our back office operations. And I was at dinner last night with one of our newer advisors, and he was just singing the praises of Farther and how much this has changed his mindset. It's re-energized him. He's grown 40% since being at Farther. And that tracks with what we see in the industry, right? Our advisors here at Farther are growing 3 times as fast as advisors at other firms. And that's because of the technology that we've developed and the efficiencies that we are integrating within the practices of these financial advisors. That excitement, that growth is what leads to just an amazing culture of innovation, collaboration. At the previous firms that I've been at, it was, hey, good luck. If you need some help, here are some resources, right? And when I look across the landscape of Farther, we use Slack for some internal communication, and people are always asking, hey, is anyone familiar with this internal revenue code and how it applies in this situation? And there's immediate feedback, and it's just everybody coming alongside each other to grow their individual practices, but also to grow farther. I mean, we're all in this together, and that's why I think that we are the fastest growing financial services company this year. And I'm really proud of the team that we've built here at Farther, and the best is yet to come.
Yeah, let's talk about like the yet to come piece. What's the I mean, I'm sure we could talk about AI and technology and things, but I guess maybe even outside of those changes, if you think about the next 5 to 7 years at Farther, how big is the opportunity? How can the landscape change because of Farther? It already has. But if you think 5 to 7 years out, what do you feel like is next?
Well, the TAM in our space is huge. We've already talked about the generational transition of wealth. Think about who is inheriting that wealth. They're much more technology savvy. They want to be involved a little more in the planning process. And that's exactly what we've built, right? We've built a modern technology platform that allows advisors to have more efficiency in serving their clients, but it also allows clients to be more engaged in that process. So I think we will see this large generational transition of wealth being served by fewer advisors. I mean, we're already seeing that. We had talked about the 38% of advisors retiring. Well, the success rate of new advisors coming into the industry is only 3%. So this is a supply-demand imbalance. And I think Farther is positioned to capture a large portion of this generational shift in wealth due to being tech-oriented, to being a modern wealth platform, to being this digital family office where you have one location for all things regarding your financial life. So I'm really excited about where the future goes. And, you know, when I look at our deployment of new technology and how AI has enabled us to accelerate the deployment of new features, it's exponential. So we're now able to deliver for our advisors and our clients in a much more effective way. And the advisor and client experience are being elevated on a daily basis.
That's awesome. Yeah, I think we've been following along with what Farther's doing, gotten to talk with a number of your advisors as well. Even actually back before we met, I had engaged with several Farther advisors at different stages, folks who had just joined, folks who had been there for a little bit longer. I've always heard, really, really great things in terms of their experience working with your team. So, excited to work together more in the future and hopefully share some clients and Thanks for coming on and sharing more about your vision, about Farther's vision, especially about the work that you've done to help raise the bar for the advisor-client relationship. Appreciate that.
Yeah, and you as well. I know I've already said this, but just thank you for focusing on the educator. We need that. That's what we're trying to do. So the more professionals that we can pull together to provide the education, both to advisors and to our business owner clients, it reduces the cognition inhibitor and really allows us to provide a tremendous amount of value to the clients that we're serving.
Awesome. Yeah. Thanks so much, Daniel. And we'll talk again hopefully in the future.
Absolutely. Thank you.
Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.